The Little Book of Common Sense Investing by John C. Bogle. This book is a seminal work on the principles of investing. It emphasizes the importance of simplicity and long-term thinking in achieving financial success. Bogle, the founder of Vanguard Group and the creator of the first index mutual fund, uses this book to lay out a clear, compelling argument for investing in low-cost index funds over the more complex, higher-fee strategies that many investors are drawn to. Here's a 1,000-word summary of its key ideas and takeaways. Introduction: The magic of simplicity. Bogle starts by explaining the core philosophy of common sense investing. The best way to invest for the long term is to own a diverse array of stocks at the lowest possible cost. He believes in the power of simplicity and rejects the allure of speculative trading and actively managed funds that promise high returns but often fail to deliver. According to Bogle, most investors fail not because they don't try, but because they overcomplicate the process and allow emotions to drive decisions. Chapter 1: The Arithmetic of Investment Returns. Bogle lays the groundwork by explaining the mathematics behind investing. Stock returns come from two sources: the earnings generated by companies' dividends and earnings growth, and the speculative returns changes in market valuation. He explains that while speculative returns can vary wildly, the long-term returns from dividends and earnings growth are much more predictable and stable. Therefore, investors should focus on the long term rather than trying to time the market or pick individual stocks based on speculation. Chapter 2: Rational Expectations. One of Bogle's most important points is setting realistic expectations for investment returns. Historical data shows that the stock market has provided an average return of about 9% per year. However, many investors expect much higher returns and are often disappointed. Bogle emphasizes that expecting reasonable long-term returns is more likely to lead to success than chasing after unrealistic gains. He cautions against trying to beat the market, because doing so often leads to higher costs and lower returns. Chapter 3: The Superiority of Indexing. Bogle's central thesis is that most investors would be better off in a low-cost index fund than in actively managed funds. He presents data showing that the majority of actively managed funds fail to beat the market over time, even when a fund does outperform. It's extremely difficult to pick which one will do so in advance. Index funds, which simply aim to match the performance of a broad market index like the S&P 500, eliminate the guesswork, lower costs, and avoid the pitfalls of market timing and stock selection. Chapter 4: The Cost Matters Hypothesis. One of the book's recurring themes is the importance of minimizing costs. Bogle introduces what he calls the cost matters hypothesis, which is a response to the more widely known efficient market hypothesis. The latter suggests that it is impossible to consistently beat the market, because all available information is already reflected in stock prices. Bogle doesn't fully agree with this, but he argues that costs management fees, transaction fees, and taxes are one of the few things investors can control, and they have a significant impact on long-term returns. Index funds, with their lower fees, are almost always a better option for the average investor. Chapter 5: Taxes, the Silent Killer. Taxes, like fees, can significantly erode investment returns over time. Bogle highlights the tax efficiency of index funds compared to actively managed funds. Actively managed funds tend to generate more taxable events, as fund managers buy and sell stocks more frequently. Index funds, on the other hand, have much lower turnover and, therefore, tend to generate fewer taxable gains. Over time, the tax savings from investing in index funds can make a big difference in an investor's net returns. Chapter 6: Diversification. Don't put all your eggs in one basket. Diversification is a key principle of investing, and Bogle emphasizes its importance throughout the book. By owning a broad array of stocks through an index fund, investors can reduce the risk of any one company or sector, causing significant damage to their portfolio. Bogle argues that a well-diversified portfolio will smooth out the ups and downs of individual stock performance, leading to more consistent, long-term returns. He cautions against putting too much money into individual stocks, sectors, or even asset classes, advocating instead for a broad mix of assets. Chapter 7. The Long-Term View. A central tenet of Bogle's philosophy is that investors should focus on the long term. The stock market is volatile in the short term, but over time, it tends to rise. Attempting to time the market, or make short-term trades, is not only difficult, but also costly. Bogle argues that investors should stay the course, avoid reacting to short-term market fluctuations, and let the power of compound growth work in their favor. He advocates for patience, discipline, and maintaining a steady investment strategy over time. Chapter 8. Human Behavior and Investment Decisions. Bogle acknowledges that one of the biggest challenges to successful investing is human behavior. Investors are often their own worst enemies, driven by emotions such as fear and greed. In bull markets, they tend to become overconfident and buy more stocks, only to panic and sell during bear markets. This behavior leads to poor investment decisions and diminished returns. Bogle stresses the importance of discipline, sticking to a plan, and avoiding the temptation to chase short-term gains or react to market noise. Chapter 9. The Value of Simplicity. Throughout the book, Bogle returns to the idea that simplicity is key to successful investing. He argues that most investors do not need to worry about complex strategies, frequent trading, or trying to outsmart the market. A simple, low-cost, diversified portfolio of index funds, held for the long term, is likely to outperform the vast majority of more complicated strategies. Bogle criticizes the financial industry for promoting complexity, arguing that it often serves the industry more than it serves individual investors. Chapter 10. The Virtue of Patience. Bogle concludes by reinforcing the importance of patience. The most successful investors are those who have the discipline to stick with their strategy over the long haul. He emphasizes that there will always be ups and downs in the market, but over time, the market has consistently rewarded those who stay invested. He advises investors to ignore short-term market movements and the constant barrage of financial news, and instead focus on their long-term goals. Conclusion. The common sense approach. In the final pages, Bogle reiterates his core message: investing doesn't need to be complicated. By focusing on the long term, keeping costs low, and staying disciplined, investors can achieve their financial goals. The common sense approach to investing, as Bogle sees it, is to avoid the traps of active management, excessive trading, and speculation, and instead, embrace the simplicity and power of low-cost index funds. Final takeaways. Index funds outperform most actively managed funds over time. Costs, including fees and taxes, matter greatly in determining your investment returns. Diversification reduces risk and increases the likelihood of steady returns. Patience and long-term thinking are crucial for successful investing. Investors should ignore market noise and stay the course with a simple, disciplined strategy. Bogle's book provides a compelling argument for index fund investing, underpinned by data logic and decades of experience. It offers timeless advice for investors of all levels who are seeking a reliable, low-cost path to financial success.